That's very much what China appears to do. Give you a little bit on the record March imports on silver, and the fact that US on the product level, particularly category, didn't have a record trade deficit on account of massive gold sales over 5 months to China. Give us a comment on that as well, Bill. What's your take?
You mentioned China. China is no longer exporting any silver to the world. So you're looking at, and that's been in a structural deficit for over 5 years. So you're looking at a supply and demand situation. It's unbelievably bullish. Yet, people are wringing their hands because silver came down from $120 and gold came down from $5,400. Well, think about where we were. Think about where we came from. Gold and silver deserved and needed a pullback. It needed a correction. Now, did silver need a 50% correction? In other words, trying to cap the rise in gold and silver to disguise, if you will, the collapse of the currencies.
The global monetary system faces a critical transition, putting precious metals at the center of the debate. Bill Holter, an expert in systematic risk, and francishunt, known for macro and technical market analysis, discuss why gold and silver may be on the verge of historical repricing. Bill notes that rising Chinese demand, a persistent silver supply deficit, and escalating pressure in paper markets expose deeper systematic issues. He emphasizes that silver shortages and excessive leverages are underestimated risk for investors. francishunt notes that when measuring assets against gold instead of fiat currencies, many traditional assets already look weak, which could signal trouble for the broader economy. This is why each correction in gold and silver signals increased market tension, not the end of the long-term uptrend. These pauses may precede further major upward moves. Before we discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
Yeah, it's people not realizing what it is. Would you say there's in actual fact, rather than people being upset, they should see it as the discount window that should be exploited? And that's very much what China appears to do. Give you a little bit on the record March imports on silver, and the fact that US on the product level, particularly category, didn't have a record trade deficit on account of massive gold sales over 5 months to China. Give us a comment on that as well, Bill. What's your take?
You're talking about supply and demand, and there's more demand than there is supply, but the mine supply is barely moving higher. In the case of silver, it's not moving higher at all. You mentioned China. China is no longer exporting any silver to the world. So you're looking at, and that's been in a structural deficit for over 5 years. So you're looking at a supply and demand situation. It's unbelievably bullish. Yet, people are wringing their hands because silver came down from $120 and gold came down from $5,400. Well, think about where we were. Think about where we came. Gold and silver deserved and needed a pullback. It needed a correction. Now, did silver need a 50% correction? No, that was helped along with paper contract. The CRB, this past Wednesday and Thursday, I was looking at the CRB chart, and that's clearly broken out. And all the blocks are in place now. You can clearly see the block for stagflation, whereas the real economy slows, inflation heats up, and asset prices decline. People will say, oh, well, asset prices aren't declining. Well, yeah, real estate is stagnating. Commercial real estate's already collapsed. The bond market, which that's most important because everything runs on credit, the bond markets around the world are collapsed. And the currency markets are collapsed. And you can say that because by just looking at the price of gold, nothing else matters. It's gold versus currencies. And no, gold didn't go up. That 1 ounce of gold is still just 1 ounce of gold. That's all it is. It's the measuring stick. And what it measures are currencies, and currencies have collapsed. The dollar has lost roughly 50% of its value, purchasing power value, in 2 years, from going from 2,500 to 5.
Yeah, that's a brilliant points. And I want to make clear, when you said assets, you're talking about the financially leveraged assets rather than the commodities and the monetary metals.
Yeah. Paper assets.
Yeah.
Paper assets.
Which is property as well because of the leverage. Everyone's got leverage to buy in. It's a commercial real estate, an absolute busted flush. So actually, in my opinion, and I think it sounds like we're in agreement here, that everything bubble, bar the NASDAQ stock market, really. But if you look at it in gold ounces, it's already started to turn despite this rally. is actually contracting. The everything bubble is contracting, providing you're using the gold ounce, which is our point of call, as your unit of account, on the basis that all other fiats are in chronic debasement right now.
Well, Francis, even if you don't use gold as the yardstick, which it is, even if you use the dollar as the yardstick, if you look at the stock market, the breadth has been horrible. The amount of new 52-week lows, there's no way when you have a market making new highs, you should have this many 52-week lows. So internally, the markets stink. The generals, the top 10 or 20 stock, are carrying the averages while the soldiers are retreating.
Yeah. Yeah, and that's a function of the BlackRock ETF and everybody getting the low-cost ETFs, foregoing their voting proxy to a big asset manager like BlackRock or the others, State Street, etc., and success breeding further success to the point of hypervaluation. Is there anything else you would add to that?
I think that covered it pretty much.
And that should mean that at some point when gravity finally bites, you mentioned such a good point. You said interest rates are rising. All forms of traditional valuation. I mean, we had Amazon go.
Are based on interest rates.
Yeah, exactly.
Yeah. All forms of traditional valuation are based on interest rate.
Yeah.
When interest rates go down, valuations go up. Rates go up, valuations go down. The fact that interest rates have gone, the fact that we have the valuation levels that we have today and interest rates have gone up makes those valuation levels even more absurd.
Correct. It's the weighted average cost of capital was the term that's the basis of every MBA. Go ahead.
I was just going to say one other thing. You mentioned the everything bubble. Understand that the leverage in the gold and silver market and in many commodities is to the downside. It's the short side. So when the bubble bursts, there's going to be some forced buying in gold, silver, and other commodities. Because if you go back to 1987, when the market crashed and they used $6 million went into the value line index, that was the only index that was open, and that's what turned the market, a whopping $6 million. They learned that they could control markets with derivative, with leverage bet. And the president's working group on financial markets, aka the plunge protect, has been at it every single day in every single market ever since. So they've financially engineered using very small amounts of capital to control entire market pricing structure. They levitated stocks, they levitated bonds, real estate was levitated because interest rates had gotten so low. But when it comes to real assets like commodities and in particular gold and silver, that leverage is selling short. In other words, trying to cap the rise in gold and silver to disguise, if you will, the collapse of the currency. So when the bubble bursts, the ultimate move, you probably will see first move downward in gold and silver when everything collapsed, but the ultimate move is going to be the upside. Shorts have to come.
And violently. Now, it took me the second take to understand what you were actually saying when you said the leverage is to the short side on the metals, and that was a beautiful and I want to draw a line under that for everyone watching, because I haven't heard it put that way. But essentially, if you've got a dividing line here, you've got a floor on this side and a ceiling on this side, and they are co-managed by the same money and the same leverage. The floor is keeping the stock market and all the leverage assets up, and the ceiling is keeping the precious metals down. Lose the floor, you lose the ceiling. And that's when you get the seesaw suddenly tipped violently in that way. And that was a beautiful explanation.
Conversely, if you lose the ceiling, you lose the floor.
Yeah. Which it doesn't matter which one's first. Yeah.
Right.
That was a really fascinating. I love that the leverage is to the short side on that.
Leverage is central theme. Bill Holter explains that inflated debt and leverage prop up paper assets while prolonged shorting has suppressed gold and silver. A loss of confidence in the system could trigger a sharp repricing event. Francishunt ties this to the broader asset bubble, observing that while stocks, bonds, and real estate appear expensive in dollar terms, many assets have been losing value when measured in gold. The metals market's significance now comes from signaling distrust in fiat systems, debt markets, and central bank credibility. If this distrust grows, gold and silver could experience much sharper gains. Now, let's get back to the interview.
For people that have been out of the market, that are wanting some hope, what are your predictions? And it's hard. I don't know on what basis you would do a number. I'm a chartist, so I have my own charting methodologies. But where do you think gold ends at the end of this collapse event? So the peak bottom, the spill, the 2009 moment, only far larger, I'd imagine, along with some elements of the 70s, only more extreme because you're far more indebted. Where does gold end up? And is it more a statement on the dollar than the price? But where would you say, in terms of predictions, once the dust has settled on the collapse? And does it also, I'm making this a bit of a long question, sorry, I should maybe break it up into two, but does it also preclude that we're first going to get a demand-destroying event collapse, the stock market collapse, all of this, and they might get a short dip in the rates, and they'll quickly get a bunch of bonds out, and that will have a further dip in gold and silver before we get to that eventual number that you'll give me your forecast for?
Yeah, you're asking for a final number. It depends on what currency you're asking the question in, but I'm assuming dollars.
Yeah, dollar.
In dollars, there's no way to answer that. I would say approaching infinity, because first off, we don't know how much gold the U.S. has.
Yeah.
They say 8,300 tons. There's not been an audit since 1956.
Yeah.
Is it half of that? Is it a quarter of that? 10% of that? There's no way to know. So there's one part of the numerator, denominator that you don't.
I'm going to say zero. By the time they're done, I'm going to say zero.
Then the answer is infinity.
Yeah. In dollar terms, then it is virtually infinite, because then essentially the currency is unbacked.
Right. Well, it is unbacked.
Mm.
I mean, it doesn't matter whether we have the 8,300 tons or not, because that's not even $1 trillion. And on and off book debt and obligations, you're talking $200 trillion. So less than $1 trillion is not going to support $200 trillion.
No.
So the other side of the equation, we have no idea how much new money supply is going to be issued. We have no idea how much new debt is going to be issued. There's no way to know. But the real answer is it approaches infinity, because mathematically the debt problem, the debt can't be paid. The money does not even exist for that debt to be paid. So they've got to create more and more and more money supply.
So say that it's which year? Is it 1993 or even before that? The volume cut out a bit there, the signal.
Pre-1933 gold.
1930.
The Liberties were produced, I think, from 1850 to 1907, and St. Gaudens were produced from 1907 to 1932.
So on that basis, that it affords an additional protection, I'm sure it may well have an additional premium attached to it. But
that was historically they've had a 20 to 30% premium over spot, and for that reason. And right now, because you've had a lot of selling, you're seeing silver. You can buy junk silver below spot, and if you go back 3 years ago, it was $13 over. So what's happening in silver is that the dealers are not holding it. Any sales they're sending off to refiners to melt it down, but the refiners are back up 6 to 8 weeks. So the dealer the dealer pays out, but they don't get paid for 6 to 8 weeks. So they crushed the bids. I mean, the bids are like $8, $9, $10 under spot. And that's the dealers or carry that for a month or two. And the same things happened with the pre-1933 gold. There's been a lot of sales of that. And this is a function of people selling because they need money. The money on the street is thinning out. You've got people selling, and dealers aren't going to hold the various issues of the pre-1933 gold. They're actually sending those in to be melted. The bids are under spot, which is insane. You can buy them for the same or lesser price than an eagle. So why would you buy an eagle when you can buy a piece of history that will never be produced again? And they're producing eagles every year. And again, going back to junk silver, that stuff hasn't been produced since 1964. And the fact that the existing supply has put refiners 6 to 8 week backlog melting this stuff down. Where are we going to be from now? Where's the supply going to? They don't mint it.
Yeah. So actually, it sounds like a very good recommendation, and it sounds you're making a very strong case for buy junk silver and buy
silver. You buy pre-1933 gold. That's no brainer.
Excuse my ignorance on the States markets for both those numismatic coins, but are they still 999, or is there are they a little bit less pure? Is there a bit of copper in the gold, or how does it work? Is it 39s?
The pre-1933 gold is 0.9675 of 1 ounce.
Yeah,
That's what you're trading basically spot. the junk silver, and that is not numismatic. Junk, here. The dimes and quarters are 90% silver. So if you have a $1 face amount, it's 0.715 of it.
That seems like a really useful a bit of information and intel for everybody to latch on. If I was in the stateside, that's where I'd be hoovering up.
Yeah, and junk is going to be best. It's the best form for American to own, because when this system, it's not a question of if now. When the system comes down, you're going to want to have silver, because that you can barter with silver. You really can't barter with gold, because if you do a trade with gold and it's above whatever you're buying, now you're issuing the seller credit. He owes you money. But you can do it with silver, and 14 dimes equals 1 ounce. So you got 14 transactions with 1 ounce versus 1 with a silver eagle, a bar, a generic coin, a maple leaf, a coup grand, whatever. Junk silver, hands down, is the best form for America. And it's the cheapest form there is. You can buy it on the spot.
Yeah. And that's flow spot for the 90% content, is it?
Correct.
Yeah.
Right. You pay nothing for the copper content.
Yeah.
This interview reveals that the real issue is eroding confidence in the fiat currencies and a growing sense that the global debt system is near its limits, far outweighing day-to-day price shift. Billholter argues that gold does not truly rise in value. Instead, it reflects the declining purchasing power of currencies. A move from $2,500 gold to a significantly higher levels would represent a major loss of confidence in the paper money itself. He also warns that leverage across financial markets remains dangerously high, which could create sharp volatility if liquidity conditions tighten. Francishunt explains that many major asset classes already look weak relative to gold, even while stock indexes remain elevated. Underlying market breadth continues to deteriorate. That divergence often appears near major turning points. This is why gold and silver command intense attention. Supply deficits, central bank buying, debt growth, and instability all point to a single long-term trajectory for the metals. For investors following gold, silver, and the global financial reset narrative, this discussion delivers a serious warning about where markets may be heading next. Share your thought about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.